Everyone's asking the same question right now. Will Australian house prices crash in 2026? But here is what's interesting. While most people are frozen with fear, refreshing news websites and waiting for the perfect moment, smart investors are doing something completely different. They're not predicting, they are positioning. And over the next 12 minutes, I am going to show you exactly what they are seeing, what they are doing, and how you can think like them, irrespective of whether prices crash, rise, or do something in between. Because here is the truth. It's not about being right about the market. It's about being ready for whatever it does. Let's dive in. Alright, let's set the scene. If you have been watching the Australian property market over the last 2 years, you have seen some wild swings. In 2024, we had a bit of slowdown. Melbourne even saw prices dip. Interest rates were sitting stubbornly high at 4.35% and everyone was feeling the pinch. Investors' activity cooled off. First-home buyers were struggling. The market felt stuck. But then 2025 happened. The RBA delivered 3 interest rate cuts, bringing the cash rate down from 4.35% to 3.6%. And suddenly, the market woke up. Core logic data shows national prices climbed up. Auction clearance rates improved. Buyer confidence returned. So here we are, standing at the edge of 2026. And the big question is whether this momentum will keep rolling, or are we about to see the correction everyone's been predicting? And look, the experts are divided. The big question: some of the Australia's biggest banks are surprisingly bullish. ANZ is forecasting a cumulative 11% price growth by the end of 2026. Westpac has doubled their forecast to 9% growth in 2026 alone, with Melbourne potentially leading at 10%. NAB economists are calling for 6% growth across all capital cities. But here is the twist. Other analysts are more cautious. They are pointing to stretched affordability. Housing prices are now nearly 8 times the average annual income. It takes the average Aussie 10 years to save a 20% deposit now. So who is right? Here is where most people get it wrong. They try to pick sides. They want to know crash or boom. But experienced investors, they are asking a different question entirely. They are asking, what are the forces at play? How do I position myself to win either way? Let's break down the 4 major factors shaping 2026, and more importantly, what smart investors are doing about each one. Factor 1: interest rates and inflation. This is the big one. Right now, the RBA cash rate sits at 3.6% after those 3 cuts in 2025. And here is what most economists are predicting: another 2 to 3 rate cuts over the next 6 months. Westpac thinks we could see the cash rate bottom out at 2.85% by early 2026. Now, why does this matter? Every 0.25% rate cut adds about 9,000 to average earners' borrowing capacity. That's not pocket change. That's the difference between being locked out of a suburb or being able to afford it. And here is what's interesting about Sydney and Melbourne specifically. They are the most sensitive to rate changes. When rates fall, those markets typically move fast and fastest. And it's why analysts are predicting Sydney's median could jump by 154k by the end of 2026, potentially hitting $1.68 million. So, what are smart investors doing right now? They are not waiting for rates to hit bottom. They are getting their finances in order now. Pre-approval sorted, borrowing power maximized, and they are ready to move when the right opportunity appears. Because here is the thing. By the time everyone realizes rates have bottomed, the best deals are gone. The smart investors aren't predicting, they are positioning. Factor 2: supply and construction costs. Now, let's talk about the supply, because this is a silent factor most people aren't paying attention to. Australia has a housing shortage of 200k to 300k dwellings right now for the population we already have, not the population we are expecting. The government set a target: build 1.2 million homes by 2029. That's 240k new homes per year. But in the 12 months to July 2025, only 188k new homes were approved. We are falling 40,000 short annually. And here is where it gets worse. Housing completions are expected to drop by up to 1/3 in 2026 before recovering in 2027. Construction costs are still elevated. Labor shortages persist. New listings have fallen 12% nationally. Think of the housing market like a slingshot. The tighter it's pulled back, the stronger the rebound. Low supply creates a price floor. Even if demand softens a bit, if there is nowhere near enough housing to go around, prices don't crash. They just stop rising as fast. So, what are experienced investors doing? They're focusing on the markets with strong infrastructure pipelines and population growth. Places where supply constraints are most severe. They're not chasing the hottest market of yesterday. They're buying where tomorrow's shortage will be felt most. Factor 3. Population growth and migration. Here is a stat that'll surprise you. Australia's population grew by 420k people in year to March 2025. That's roughly the size of Canberra, added in a single year. Between 2022 and 2024, 81% of our population growth came from the net overseas migration. And despite government efforts to moderate the intake, migration remains robust. Western Australia and Queensland are leading the change, with population growth above pre-pandemic levels. Now, here's the thing about migrants. Only 38% own a home after 5 years in Australia. That means sustained rental demand for years. And the rental market right now, it's brutal. National rental vacancy sits at 1%. Perth is at 0.4%. Brisbane, 0.8%. Sydney, 1.3%. Anything under 3% is considered a landlord's market. This is pushing gross rental yields to 3.74% nationally, the highest since 2019. What does this mean for investors? Cash flow is back. For years, property investment in Australia was all about capital growth. Rental yields were terrible, but now you can actually make money while you wait for growth. Smart investors are targeting high-yielding markets with strong population growth. They're building portfolios that pay them to hold because the yields are so strong and demand is high. You can weather any storm. Factor 4. Investor sentiment and market psychology. Alright, let's talk about something that doesn't show up in spreadsheets, the psychology. Investors lending jumped 29.8% in 2024. Why? Because experienced investors see what's coming. They're not waiting for certainty. They are moving while everyone else is still scared. There's an old investing saying, be fearful when others are greedy and greedy when others are fearful. Right now, we are in that middle zone. Fear is fading, but confidence isn't fully back. And that's exactly when the best opportunities appear. Let me tell you a quick story. Back in 2020, when COVID hit, everyone expected a property crash. News headlines were screaming doom. People were convinced prices would tank 20, 30, even 40%. But those who bought in that fear, they made 20 to 30% gains within 2 years. Why? Because they understood something crucial. Markets don't crash when everyone expects them to. They crash when no one sees it coming. Right now in 2025, everyone is talking about a potential crash. Everyone is watching the same data. That's not how crashes work. Here is what smart investors are focused on. Fundamentals over feelings. They're asking, is there strong rental demand? Yes. Is supply constrained? Absolutely. Are rates falling? They are. Is population growing? It is. They're not trying to time the absolute bottom. They are buying good assets in good locations with strong cash flow and holding for the long term. Because here's the secret. Time in the market beats timing the market every single time. So let's get on to the verdict. Crash or rise? So what's the verdict? Are we crashing or rising in 2026? Here is what the forecasts say. ANZ 5.8% growth in 2026. Westpac 9% growth nationally. Melbourne at 10%. NAB 6% growth across capitals. CBA 4% growth. The consensus, moderate to strong growth. But here's the more important truth. It doesn't actually matter if you are an investor thinking long term, whether prices rise 4%, 9% or stay flat in 2026. If you have bought a property with strong fundamentals, good cash flow in a growth corridor with infrastructure and population behind it, you are going to be fine. The RBI itself has said that government first home buyer schemes could add $28,000 to $52,000 to property prices. That scheme launched in October 2025, bringing 70,000 additional buyers into the market. Combined with falling rates, chronic supply shortages and strong population growth, the fundamentals are pointing up, not down. Could there be a short-term volatility? Of course. But crashes require three things: oversupply, economic collapse, mass unemployment. We have none of these right now. So here are some strategic takeaways for investors. Alright, let's bring this home with 3 strategic moves you should be making right now. Focus on cash flow and location fundamentals. Don't chase headlines. Buy where yields are strong, rental demand is high, and infrastructure is coming. Perth, Brisbane, and parts of regional Queensland tick these boxes right now. Keep your borrowing power flexible ahead of rate changes. Get your pre-approval sorted. Reduce unnecessary debt. When rates drop further and competition heats up, you want to be ready to move fast, not stuck in organizing paperwork. Invest where population and infrastructure are growing. Follow the people at the projects. New hospitals, transport links, schools, they signal long-term demand. Smart investors aren't buying where prices rose last year. They're buying where the next wave is building. And here's the mindset shift. Stop trying to predict the market. Start preparing for the opportunity. Look, predicting markets is gambling. Position for opportunities, that is investing. Whether 2026 brings 4% growth or 9% growth, whether there's a correction or a surge, the prepared investor wins either way. You don't wait for the perfect clarity. It never comes. Get your strategy right. Get your finances right. And focus on assets that work in any market. Cash flow, strong locations, long-term fundamentals. If you found this breakdown helpful, hit the subscribe. I drop weekly deep dives on Australian property investing, breaking down the data so you can invest smarter, not harder. And drop a comment below. Are you buying in 2026 or sitting in sidelines? I would love to hear your strategy. Until next time, stay sharp, stay strategic, and I'll see you in the next one.